All right, third time's a charm. Here we go. So for this lesson, it's going to be on vertical spreads. Most of you that have been with me now for a while know what a vertical spread is, so this will be a refresher. There have been, quite a few new members, so this will be a good lesson for you guys as well. So, vertical spreads. These are my top three. They are what I do probably the most. Most of my positions are vertical spreads. And what are they? Too far. Here we go. A vertical spread involves two contracts, a short leg and a long leg. And depending on if you're doing a debit cred or a debit spread or a credit spread, will determine where your short and your long is at. And then it is a directional to kind of neutral strategy, right? So, and then I have a little note here. I don't trade debit spreads all that much. Okay, I really only trade credit spreads. So I'm not going to touch on debit too much in this lesson. That'll be a whole nother topic. I'll just kind of give the basics on it. Okay, so there are two different types of spreads. Like I touched on just a minute ago, we got a debit spread and a credit spread. On the left is a debit spread, and as you can see here, it's directional. You can see a debit spread is pretty much on this one would be a call debit spread, and that is if you think the stock's going to go up, right? The one on the right is a credit spread, and this is on the put side. It too is directional, and also if you want it to go up, same directional move. So likewise, you could do the same thing, switch it over and do a put, right? And you'd go down the opposite way, and a credit would go down that way. Okay, so I'm just touching on the call side for now. And they're two different. As you can see, one, the debit spread, just you put those on in a low IV environment, just like when you would do a long call or put. You want to buy low, sell high. So the whole IVR comes into effect here as well. And the higher the IV, the better, because lower IV, the better. We're talking about debit spread here. Lower IV, the better, because you want to buy low, and then you want to sell it at a higher price. So on a debit spread, those you put kind of at the money, and you really got a directional move. You need it to run up, or if you're on a put side, you need it to run down. Okay, and you have a 50-50 chance. Just like if you put on a straight long call, you really got a 50-50 chance if you're going to win. Okay, I don't trade them much. I don't like the 50-50 chance. I don't like choosing a direction hoping that that's going to be the correct direction. Okay, mine I do is credit spreads. I sell the premium. So in this case, I would be selling an out of the money put spread. Same directional effect, but it's not a 50-50 chance anymore. I am. Okay, it's not a 50-50 chance. It now raises up to, depending on your deltas, it could be a 60, 70, 80% probability of profit. Okay, so, and you can see the difference, right? A debit spread, this is really directional. You need it to move, right? Here's at the money. If it falls below, you lose. A credit spread, this is where the directional / neutral strategy comes in. You've got a trend that's going up, so you put on or down, up, down, down. I'm looking on the wrong one. You think the trend's going up. We'll go with Roku, for example. You can put on a credit spread instead out of the money. Now, you can be wrong. And you could be wrong in this example. It's at the money's roughly $150. You could be wrong $10. It can go against you. And you still make money come at the end, right? You'll be upside down because you put it on and then it goes against you. You'll be upside down starting off. But in this case, it's trading just hypothetically say 150. If it drops down to 140 and 1 penny at expiration, I still make money. But over here on a debit spread, it's pretty much a loser. You're out. You're not going to make any money. So this is what I mean by, okay, it's in a directional trend. It's heading up. But say you put it on and now it's only going sideways at 150 for a week. Well, that's perfectly fine because you're still going to make money. You're still out of the money. And you're going to make money on the trade. So this is why I choose credit spreads. I have a much higher probability over a debit spread. Okay. So, in a little bit more detail here. This is a vertical spread. This is the same one here that I have up right here. And I brought in a little bit so you can see what I'm talking about here. So now I am out of the money with some time, okay? And you can see the probability on this. This is the pop. Most of you are aware of, if you know Tasty Trade, that is the chance of making 1 penny or more by this day here, which in this case would be January 17th. The P50 is your percent chance to make 50% of max profit prior to expiration. So in this case, I mean, I just threw this together, but this is a high probability trade, right? And it's 77% chance that I'm going to make a penny by expiration, but an 84% chance that I'm going to get $40, right? 40 cents out of this before January 17th. Okay, so that's why I like that. So the risk and reward's a little bit different, right? You're going to make less, but your probability is a lot higher. So I come over to a debit spread, and here you go. At the money, you can see that my pop is pretty much a 50-50. Just like if you went and did an at the money long call, you're going to pretty much have a 50 delta. So as you can, that's where we're kind of sitting. And you can see, okay, my max profit significantly higher, max loss significantly lower, but again, 50-50 chance, okay? So when I come over here and I show you a little bit better visual on the P&L, here's the credit spread, okay? Here is where the stock was trading, right? And we go back, you can see, here's the stock. So the 140 and the 135. Now you see that my profit potential here, the stock can come down $7.50 and I'll still be 100% winner, right? It can rally or it can trend sideways. And this stock would be this option play would be 100% winner. I don't start taking max loss until after 135. So it'd have to drop, what, $12.50? Okay, now versus a debit spread. You can see here it is pretty much 50-50 chance. This needs to stay at, which is where your neutral strategy comes in, or it needs to rally in order to make any sort of money. As soon as it drops below where it's pretty much trading, you're now negative. And a lot of the times, in my experience, if it doesn't run within a few days of you putting this trade on and it starts to fall, it's not going to recover again. That's my personal experience, and that's one reason why I do not like putting these debit spreads on. I only have this chance. This is much better. Okay. When do you place these trades? Okay, and now I'm only jumping on to credit spreads again. Credit vertical spread is a high IV type trade. So you want 50 to 100 is considered high. In this market that we're at, it's pretty much under 50. You're not going to see 50 on very many underlines at all. So I will actually go down as low as 30 to hope of finding that trade to put on. The higher the IV, the more credit I'm going to get. So obviously if it's sitting at 50, 60, 70, you're going to get a much better credit than if you're finding only stocks trading at 25, 30, 40 IV. Okay. And then ideally is, you want it to at least be trending sideways, if not bullish or bearish, depending on the underlying you're playing. Amazon, for instance, it's kind of trending downward right now. So you'd want to put a call credit spread on, whereas Roku, you might want to put on a vertical put, excuse me, or you can even do an iron condor or both. That's another lesson. But okay, and how do you profit on the credit ones? Passage of time. That's number one, because the theta decay is actually your friend. I touch on this a lot. Theta is your friend when selling credit spreads, because the longer you're in it, if it's in your favor, those option prices will decay, and now you're going to buy it back for a lower price. It will also help you if you get a directional move. You get the 2 into 1, and you got a nice winning trade here. Meaning if you put on a put spread on Roku and Roku takes off, well, you're going to make a lot more money because it's moving in your direction, so those prices are going to decay and drop significantly faster than if Roku just trended sideways. Okay, IV contraction, that kind of goes with the passage of time. This could be binary events like an earnings play where you got high IV and you're just going to play the contraction. You would buy it back at a lower price after that binary event. And then you also profit if it stays above or below your short strike by expiration. And then obviously you buy it back for a debit lower than the credit you received. Okay, well, wrong me. Here we go. When I manage at 50% of max profit. That means if I got $1.60 in credit, I want to buy it back for 80 cents. That'll give me 50% of max profit. Okay. You can also manage it by rolling down the calls or up the puts to collect an additional credit. These can go kind of different ways, but on a vertical, if it's running in your favor, so you say Roku took off, you got 30 days left, you don't think Roku's going to fall, then you could roll those puts up. So say you got $1.60, you then roll them up 2 more strikes and collect another 15 cents. Now you're at $1.75, and you locked in that little bit of profit. And if you don't think it's going to fall, you can keep rolling them up until you finally just close the trade, locking in all these profits. Okay. Or you can roll out to a further expiration if needed. Rolling is not really ideal on defined risk trades. That's another lesson. Okay. So typically I'm closing them out roughly 40 to 50% of max profit. I rarely will roll down or up puts and calls, and rolling out to a further expiration, that's more defensive play, trying to salvage maybe a trade. So rarely do I roll on a defined risk play. Is 50% my rule of thumb? Yes, it is, Joseph. 50% is my go-to after 5 to 7 days. So say I put on, we'll just go back to Roku. Say I put on a Roku vertical spread on Monday, and come Friday, it's trading at 30, 35%. I'm going to take it off, because typically you buy 30 to 45 days out, and in 5 days you're already up 30%. You take it off. That's how I manage it that way. Once I hit 7 days, roughly 5 to 7 days, if I'm not at 30%, I go now for my 50%. And at that point, I'll take it. Unless something happens, the stock looks like it's reversing, take it off, manage it early, get out of the trade. But I rarely will hold past 50%, and I rarely, if ever, will hold to expiration on a profitable trade. Okay? There is too much risk involved. Typically, you see 50% within like a week and a half if everything goes right. Okay, so my average trade time, and I'll just tell you here, is 9.89 days, and that's between all the trading that I do. So mind blank. So if I'm at 50% in 9 days and I still have 35 days to go, then you got too much risk. Don't hold it. There's too many times that you have seen a 50% winner turn into a 20% loser or a max loss. So managing early helps out. Okay, and that's the end of my slides. So I know I kind of brushed through that. I didn't mean to, but any questions? And I can go through some live versions of this as well on Tasty Trade and Thinkorswim for those that don't have Tasty. But on that note, off of everything I just went through, anyone got any questions? Do I normally sell all at the time do you set your sell? Yeah, for the most part I do, Mary. I will go in and I will put in a I'm gonna take that cam off because that's not gonna work. I will go in, I'll place my order, and then I'll come in and I'll put my 30% in. Okay, so as you can see here, these are iron condors, but it's the same message across. I'll put my 30% in. That way I don't gotta worry about it. If it rallies tomorrow and works in my favor and I'm not paying attention, 30% will trigger it. Okay, and then after 5 days I'll come back in and I'll cancel this, and then I'll go redo it for 50%. Okay, so but yeah, I always do, unless I just somehow forget. I put in my closing orders right after I put the trade on. That's just one less step you got to worry about in case you're gone in 9 or 10 days or anything like that. All right. Do you have intro lessons in the Dash Pro? I'm not sure if I actually have like an intro, but I do have lessons in there, Joseph. Question, I caught this training last minute. Absolutely, Ray. When I am done with the lesson here, I will get it uploaded into my area. All right. So, let's see. Let me just I want to find one that's an example that I can use. We'll go to SPX. We'll just do that. Okay, so you see here, SPX IV is really low. We have anything with a high IV? There's not a lot of high IV anywhere. So FedEx is much better than the SPX was. I'm still in boot. Do you have credit amount? I do, Roger. Thank you. And I don't think I touched on that on the slide. I try to get, if at all possible, 1/3 the width of the strike. Now I will go down to about 1/4 the width of the strike. But getting about 1/3 makes the risk to reward worth it, if that makes any sense. So we'll bring up here, and it was FedEx that I was using. So this isn't really a good play here, and February is a little far out. So you can kind of pick. I don't like to do weeklies because there's just not enough liquidity. So we'll go out to February, and I start at a 30 delta. Okay, and I work my way from there. So 31 delta is the closest. Okay, and I put a vertical put spread on. It's just saying FedEx is going to go up. You can see here that the credit is only $1.29. That is a far cry from the $1.65, but it is right above, Roger, thank you, $1.25. So this would be the absolute like minimum I would take, but ideally, you want more credit. So low IV, the IVR is 36, the weekly only is 26, so there's not a lot of credit in here. Let's see if we can find one that's got higher IV to give you. Let's see what Dick's looks like. March is a little far, but maybe I can get it. All right, so we go to the 30 delta, and then we'll go 5 wide. Still don't get it here. So, but as you can see, I try to get at least a 1/4 of the width, which is, in this case, this is 5. This would be 1, right? So 35 cents. You're getting over 1/3 the width on $1 wide, okay? Because 33 cents is pretty much what you want. So 33, then you want 66, so it's a little shy, still good there. Then you want 99. Now we're starting to get a little bit worse, all right? And then $4, not quite, $1.25. That's the absolute lowest we'll take, okay? So otherwise, you start getting these down under $1, and it's not really worth it. Sure. Here, look at the probabilities. These are high. These are huge. These are great. Most of the time, you're going to win on your trades. But it's less than $1. You're putting up so much more risk than what your reward is going to be. There's a less chance that this trade's going to go against you. But when it does, because it will, there will be a trade that goes against you. And if you don't manage it properly, now you just got knocked out of $400 instead of $330. Right? 335 would be a lot better. Here's your 1/3 the width. Well, that's a lot better looking. Okay, but to get that, you got to really get up there. You can see how the probabilities change, and we're getting better, but not quite there. All right. I cannot see. Let's see. Awesome, Robert. Glad you're happy to be here. Mary, how far out do I like to go? That's another topic I didn't touch on in my thing. I like to go 45 days out. I took this from Tasty Trade. They have all their statistics and they're proven. 45 is the key number. Anything above 45, it's a lot slower decay. The curve, and this is what we're talking about. The curve really isn't strong 45 days out, like above 45, whereas below 45, you do get a sharp decay, but you have gamma risk. Whole nother topic, I didn't even talk about gamma. So 45 to 21, right? That's the perfect zone for your decay and your risk to your reward. So I followed that from Tasty. That's one thing that I did like between me doing a week out and 6 months out, 2 weeks out. The 30 to 45 days works. So right, if, we don't have a 45 here, just showing you here. So what would I do? Well, I'm not going to go to March because there's no February posted yet. So I would end up doing January at 29 days, right? It's not going to kill the trade. Oh crap, Dick's Sporting Goods doesn't have a 45 day and there's no liquidity in here, right? And there's the volume, it has not traded yet. Yeah, you don't want to do that. It's not going to kill you to go here. And it won't technically kill you to go to March. You're just going to be waiting. But FedEx, that one did have a February one. So try to get close to 45 days as you can. That's the good number to work with. Again, you're only in it till maybe 30 days, 90% of the time. Okay. Are you doing an iron fly during the week or use them only on Fridays on option expiration date? Off-topic question, but I do them Monday, Wednesday, Friday. But an iron fly is a neutral strategy, Emil. So like today's market, not good for an iron fly. If today was say Friday, right? So it really just depends. But that's a whole nother lesson. Okay. Roger, weeklies, monthlies, don't care. I don't care as long as there's liquidity in it, right? So here, FedEx, right? We show you 45 days. There's no liquidity. We got a couple of trades here, half a dozen trades. Open interest, I go more off of open interest than I do volume. I want to see people at least interested in it. But even here, even on a weekly, we got 2 over 100, 3 over 100. So there's not a lot of liquidity, not a lot of interest in it. But when you jump to a monthly, so much more. Okay, so whatever's got the best liquidity, closest to the 45 days. 90% of the time, I'm only trading the monthlies. But SPY and the SPX, right, the S&Ps, they have liquidity in their weeklies. There's a lot in there. So those that have liquidity, I will absolutely trade because I'll get closer to my 45 days. I can do, the 50 days here. I won't do an end of month on this one, but, go down to 36 days. And there's a lot of liquidity. So it really just depends on the underlying. How can I see IVR in TOS? It is different, Prue. It is. So Tasty Trade has it here, right? It's a top right next to the underlying. And in TOS, you have to put the study up. So TOS has a study. You can see IVR here. And just to match it up and show you guys, IVR, according to Thinkorswim, is 14 for FedEx. But according to Tasty Trade, it is 36. So you can see it. You just got to come in here, right? And then they have an IV percentile in here, somewhere around here. But you can see I already have it. Why is it not showing up? That's funny. But you can just come in here and you can select IV. And then, oh, there's my IV. Yeah, let's see. Where did it go? I'm messing up my thing. But you just come to your studies and then search for IV. And that's not going to work. There we go, IVR. You can do that and you can move it up. And then once you get it in, it'll be like right here. There's a couple of different studies, but it's the IVR that you want. Now, I don't trust Thinkorswims too much. For the most part, they match. Roku here, you can see that I have IV at 38. And in Tastyworks, it's 33. So I like Tastyworks, and maybe it's just because of all their lessons, all their statistics, all their research that they do. I trust their IVR more than I do Thinkorswim. Okay. But that's how you can get it. You just got to find it. You can come in here and put it on a watch list if you wanted to, and just look for IV percentile, and then it comes over here, and now you have it on a watch list, or you could put it on your chart. All right. Questions. Let's see. Hoda, it will be recorded. Don't you worry. You're welcome, Vijay. Let's see. All right, everyone's good. They use different points to figure out. That's why, Ben. All right. So, what was that? That was weird. All right. Let's see. Did I miss anything? I don't think I did. I think we're good on it. So, any more questions? I do not have IVR as TOS you can share. I can, Claudia, but you should have it in there. Yeah, but I could share it after the lesson, yeah. Okay, so to touch basis again, just to kind of recap you guys, SPX with an IV 3, it'd be better here to do a debit spread, right? Because you're going to pay a lot less than if you tried to sneak and get a credit spread. All right, you can see there's not a lot. The 30 delta doesn't give what we need. So this is a good example. I should be able to get 1/3 the width of the strikes, and I'm not. I'm not even getting a quarter. So because there's just no IV in the weekly here, there's no IVR. So you would come in and instead do this and hope for a directional move, 50%. Okay. Typically in a debit spread, you want 1-to-1, and this really isn't 1-to-1. I just don't think you're going to get a 1-to-1 here. The closest would be about that. No, I'm not, Ray. It's all based on liquidity. I talked to Jeff yesterday, and there are a few stocks that he's been trading that weren't really the most liquid. So I have the same problem getting fills on some illiquid stocks. I mean, we can use Ulta, for example. Ulta is actually not that liquid, you guys. You can look at it here on Tasty Trade, and you can see the liquidity for options is a 2-star. And that just means that there's not a lot of liquidity. Sure, it trades. I mean, we're not over 1 million, so it's not the biggest liquid underlying. But when you come in here and you look at this, the open interest looks good, right? We're at 2,000, 1,700. So it would look good if you looked at it that way. But once you switch to volume, 164.59, right? Ulta actually is not that liquid. So it has taken me forever to get filled at this 30%. Okay, Blue was the same way. Blue hit, I mean, that was trading in the 70s or 80s this morning, and I didn't even get filled. 20% higher than what my order is set at, and that's just, again, it's an illiquid market. So you will sit. You might take a while. But if I were to put an iron condor on SPX or SPY, which is even more liquid, it's going to be instant, okay? So he'll see that when he starts trading more liquid stocks. But a lot of the times I'm instant filled, couple of second filled, and half the time I'm price improved, meaning that I put an order in for $1.60 and I got filled at $1.62. Okay, so he just needs to switch to more liquid stocks. But I have the same issue on illiquid ones. All right. Okay, Paul, when vertical call spreads or vertical put spreads are on the wish stuff, what info do you look at to calculate if you're not profitable or not? How do you figure out how best to close to stay green? Paul. What info do I look at to calculate if I'm profitable or not? Paul, I'm not quite sure I understand your question, because if you're in a trade, I mean, here, you can look at the VIX. This is a vertical call spread that I have on the VIX right now. When you're in it, your broker should show you if you're profitable or not. Right now, I'm even, which means it's trading at what I sold it at. But how do I know to stay in it? Even if I'm negative, if it's trading above or below my strike, meaning I'm still out of the money, I'm going to stay in the trade, right? Once it starts testing the short strike or breaching it, then I'll think about it. You still have a statistic chance that it's going to touch your short strike before coming down. So I try not to get out early on a loss until I know 100% sure. Okay. Oh, okay. So you're on a weekly windfall. I can't answer that for Jay. So you would have to ask him that question. Do I always use limit orders? Yes, Roger. I don't even know if you can do a market order on a spread. Can you? Yeah, I can't even do a market order on a spread. So, it's always limit orders. Always put a limit order in. Yeah, Tasty Trade doesn't even look like it has a market order because it changes it, right? You could do a market order on a leg, but it won't let you do a market order on a spread. It just changes it to net credit or debit, and that's it. So I always do limits. I don't know if Toss or anyone like that does it, but you don't want to do a market order either. What is that noise? That must be the new alerts. Because you're going 2, 3, 4 legs. You don't want to do a market order on that. You want to try to get the best mid price possible. Yeah, I wouldn't do that, especially on maybe on like SPY, right, where they're 1 to 2 pennies wide. A market order on a spread on SPY won't be that bad, but a market order on pretty much anything with 10 cents wide or more is going to be a bad. So no, I don't do market orders. Okay. Time is that? I lost track of time, so I don't know where we are at with that, but that's basically it, guys. The vertical spreads, they're quite easy. I think they're one of the easiest ones to understand and put on. They can be a little confusing because you'll hear, I'm in a vertical spread or call vertical spread. Well, what are you in? Like, what kind of vertical spread, right? So that's why you always say credit or debit, because you could be in a call spread, but those are two different strategies. One's to the upside, one's to the downside. So you got to pay attention to that. For me, it'll always be a credit spread, unless I absolutely say debit spread. Okay, so when I talk about vertical spreads, I'm always talking about credit. And I think they're the easiest to learn. The main thing, this is what I was getting at, I sidetracked in a minute. The main thing is you got to think of a credit spread as the opposite of, you're putting it on in the opposite side. Because a lot of people, they'll see my post or they won't understand, and they don't know how to put it on. And it can be confusing, right? Like, I'm bullish on Dell. I don't know if I am. I'm just using this for example. People will automatically go to the call side because if they know options, that's what they know bullish means. You buy a call because you're bullish, or you buy a put because you're bearish. So there's a lot of confusion on how to put on, those vertical spreads when you hear bullish or bearish. I need one that actually has. So, hey, I'm bullish on it, and I'll go put my bullish trade on, but somebody else would come back on the call side and accidentally put on a debit spread because they don't know the difference. So on credit spreads or vertical credit spreads, it's always the opposite side for whatever you are in the market, meaning that I'm bullish, so I'm going to do a put credit spread, and bearish, I'm going to do a call credit spread. So that's another thing you've got to kind of try to remember. I know that was one of the harder ones that I did when I was first learning too, is, okay, well, calls are bullish. Well, no, they're not when you're selling. It's the opposite. Okay. So, let's see. Any other? I think that's really it. Again, sell high, buy low. What is going off? That must be the new alerts in the other chat room. They are. Okay. This recording will be under my section, Russ. It'll be under Raging Bull, and then scroll all the way down to James. It'll be there once I do get it uploaded. How about debit spreads? Renee, I don't do them much, even though we are starting to get into a lower IV environment. I still don't do them much. And again, I kind of went, the reasoning for is it's directional more than it is neutral. and you don't have positive theta, you try to put positive theta on. And what I mean by that, right? Because theta is your friend on a credit spread, it is your enemy when you are long option or on a debit spread, because theta doesn't work for you. You can see here an at the money debit spread has a negative theta, not by a lot, but it's got negative, and the over time you're going to lose money. So the longer you stay out, going down or out of the money or neutral on a debit spread, the more money you lose, and you need a bigger run up. Like then, because say you put this on, right, and then all of a sudden it falls, and now you're upside down. Now you need a bigger run, because now you have theta really eating away at your position. Maybe you've been at this way for 2 weeks now, and you have a 30-day trade on. So, okay, well, I got time, but these are getting eaten away, and you need a bigger run to get back up here where there's value back in the options. That is what I do not like. If you can't get in the elite room, Anthony, you do not have elite membership. If you do have the elite membership, please call customer service. So this is why I will almost always, even in a low IV environment, will sell. I will just adjust my plan, because I'm going to take a better probability and theta to work in mine, right? Because we've all been there. This Procter & Gamble, that stock is running, right? Just going crazy bullish. But you might get that debit spread on at the wrong time, and it drops $5. Oh no, now I'm negative, close out, whatever, something reasoning you stopped out. I put that same trade on a credit side of it, and it drops $5, $10, whatever, right? I may be negative temporarily, but even if it stays down 10 below and never rallies back up, as long as it's still not in the money, it's a winner. Okay, so that's why I prefer credit. You have such a much bigger high probability chance. All right, because I showed you, okay, we put this on at a 30 delta, and then like I showed on the debit spread, it falls, right? So now you're closer, so now you're upside down, but I'm still out of the money. Over time, this trade will be profitable, whether or not I get back to where I was when I put the trade on, or it even goes all the way up to a 43 delta. I may have to hold it longer. I may be negative for 60% of the time, but I'll be positive still. And you down here who put this debit spread on has stopped out by now. Okay, this is the one advantage of it. The disadvantage to the most defined risk spreads is you are capped at your max profit, right? You do a call spread, unlimited profit potential. Huge loss, right? $5,500. Same type of trade, but I mean, look at this. This is a quarter with the strikes. My profit potential is only $130. It's not infinite now, but I'm only going to lose $370 instead of $5,500 if I'm wrong, right? Worst case scenario. So I take it, right? Such a much better probable chance. 60%, 84. I mean, this is great. An 84% probability that you're going to get 77.5 cents back. Yeah, those are good odds. Okay, is why I like vertical spreads, and I'll put them on in low IV environments if I absolutely have to, just to take a little bit less cash, maybe hold them for a little bit less time or something. All right. Really hard to hear. Chat room, Kathleen. Yeah, you're gonna have to mute the one you want to listen to. James, what about some call debit spreads on VIX for upcoming months? If you a debit spread, if you think that the market's going to fall and the VIX will go back up. I mean, right now I'm actually short the VIX because the market's still rallying up. And I'll probably be that way until after Christmas, because we're kind of in that Christmas rally right now. I hope you have sound, William. I love this room. Thank you, Anthony. JB sent an alert. Both rooms up. Yep. Okay. Roger. Is this correct? Expect up, sell put spread, or buy call spread. Expect down, sell call spread, buy put spread. Exactly right, Roger. You are right. You expect it to go up, you sell a put spread, or you buy a call spread. So yeah, you nailed that perfectly. Okay. When I put on the credit spread, I have to put up so much margin. You're not that's the other misconception about it, right? Everyone knows in order to do spreads, anything worth, right, whether you're shorting, and what I mean by that is you're just selling a call or selling a put, or you're putting on a credit spread, you have to have a margin account. But that does not mean you're trading on margin, right? And when you have a margin account and you have $25,000, you can buy $50,000 worth of stock. That's not how it works with options. Options are not allowed to be put onto margin. So you're not going to go and buy $50,000 worth of a credit spread on margin, right? It just doesn't work that way. What it does is it just reserves your, typically it's what your max loss is. Okay, you may receive $1, in this case $1.45, right? We'll just go 50. We received $1.50 up front and they put that in our account. But your broker is saying, well, the risk here is your max loss because this is a defined risk trade. So I'm going to withhold $350. Okay, which I mean, take off the 150, it's really like 200. But yeah, so they're going to withhold from your margin account $350 because that's your risk. But you're not selling on margin, if that makes sense, right? You're not, okay, I got, like I said, $25,000 account. I don't get the ability to go sell $50,000 worth of option values. Okay, it's just holding your risk. Same thing, right? Buying power effect, $78,000 if I wanted to short a put on the SPX, right? My max loss is $314,000, but they're gonna only make me put up $78,000. That's what the broker determines the risk is at that time. So don't think you have to have margin times 2 or whatever to put it on. You're not using margin. So there's no overnight margin risk for, you know, the margin interest rate. So you don't have to deal with that because you're actually not borrowing cash. Okay. For put credit spreads, I find that if I choose strikes just OTM, it takes a long time to make money. That is correct, Jane. Here. You go more closer. Let's see, if I put 2 strikes just OTM, right? So just out of the money, right? Right here. You're at the money. You're risking, this is funny because this doesn't actually, it should be almost a 50%. Let me find one that's a lot better as a example here. Okay, it's pretty close. I think if I went down one more, there it is. Yeah. So if you went just out of the money, you're going to get a much bigger credit, right? And I know Bishop does this. Occasionally he goes right kind of at the money, but out of the money. Jason kind of did it for his weekly windfalls, though I do think he kind of backed off and went a little bit further, but not as far as I go. The closer you go to the money, the better credit you're going to get because they're going to pay you more for the risk you're taking, right? If you're taking a lot of risk, they're going to give you a lot more money. If you're not taking a lot of risk, they're going to give you a little bit of money, right? So think of it that way. So you need a directional move more, right? Because you're at the money. You're close to, you know, having, you know, you're not going to decay as fast as if you were out here. So your profit potential will need to have a directional move. So if you did CMG at the money spread, you're going to get $2, right? So heck of a lot better than $1.25, $1.30. But you only have a 50% pop. A little bit, you know, depends on their stats here. This one says 72% P50. But you need a move, right? If this thing went $5 against you, you're in the money now. And it's a, you know, can start really hurting you. So you need a directional move if you play the at the money plays, which is what Jason was doing with weekly windfalls. He was buying a week or two out at the money, taking advantage of the momentum. He's using his momentum knowledge that he has. Whereas I take advantage of time decay. and go further out. That way, if I have a move against me, I got a lot more time for it to fix itself than going at the money and or shorter weekly time frames. Okay. So the more out of the money you go, the higher your probabilities are, the lower credit you're going to get, the more risk you put up. Okay. The closer to the money you are, the lower your probabilities are, the more profit you could make, but that's because of the risk you're taking. Okay. And there's a lot of people that do it and are successful. And it's more like, I'm dragging off of the lesson here, but if you're good at picking trend, picking direction, and like Jason is, you know, like he goes, oh, the momentum's going to come in this and it's just going to pop. Heck yeah, you could do at the money. You could do it in the money, at the money. If you're that good at that. I'm not good at picking momentum, right? I take the probabilities into me. I don't really trade direction. I trade probabilities and I use the direction as confirmation to help my probability. And I'm gonna go off topic here. What do you mean? CMG is bullish, right? You look at this yearly chart, you can see that. So what I'll do when I go to put a trade on, I go to, again, 30 delta. Where am I at? I'm at a quarter. Doable, right? My probability is 67%. On vertical spreads, I didn't touch on this, so good thing. On my vertical spreads, I like to try to get 65% pop. That's the percent of making 1 penny or more. And I like my P50 at 70 or above. Now I'll go down to a 60 pop, sometimes a 66 P50, but I like to have at least 65 pop and a 70 P50. Okay, those are my probabilities. If I have those probabilities and I get at least a quarter width of the strikes, I'm gonna take that trade. Now I'll go and look. Okay, well, there's some value in here. What is Chipotle doing? Oh, it's going up. Perfect. I'm with the trend. That's all I do. Like, I don't need to here and be like, okay, we got a crossover. It's above. Now I do that, but that's a different challenge. I don't need to check all these things out. The chart is just for direction. Same thing with like Roku, right? Roku, you could be bullish. You can even be neutral because it hasn't, broke back up yet and it hasn't dropped past this major resistance either, support. So I go on Roku and I got 2 iron condors in here. Well, okay, on Roku, you could do something like this and be like, all right, well, it's neutral. My probabilities are, this is crap, and then you just match it. Okay, well, my short's here and here. Perfect, done. Okay. I know I went kind of offhand a little bit on that one, but let's see. Matt, brand new. No worries. Questions are fine. I don't care if it's been addressed or not. Vertical credit spreads. Do you typically sell at the money or OTM? I'd go out of the money. Okay. I start at a 30 delta, right? Because that's about 70% chance. Okay. And work my way there. Adjust the strikes as I need. So again, I'll touch on Roku here. I'll go to a monthly so it's a little bit more liquid. And I will start at a 30 delta. So 29 is close enough. So I'll put it on. Well over 1/3 the width. I don't need to collect more, right? I'd rather raise my probability. So that's right, we're in Facebook. Keep going. Hold on, I gotta check something. Where are we at? I'm even. Ugh. So, okay, $2 is great, right? $1.90, I'd much rather have that. I don't need to, you know what I mean? But why do that when 1/3 is good? I now adjust it. I'll go down. Okay, 145, 150. That's perfect. I now went down 7 deltas and raised my probability from, let's see, 66, 78. Oh yeah, I raised it 8 points. That 8 points? Yeah, 8 points on the pop and 7 points on the P50. So always go out of the money. Start at a 30 delta on a vertical spread. Okay. And then work your way down. Sometimes the lower the IV, you might have to get closer to a 40 delta just to get it, right? But I start at the 30, work my way down, because a 30 is 70% chance. Jane, I don't know how much to trust the pop. Sometimes I still lose money. It happens, Jane. It happens. I've put on my fair share of high probable trades, and that's just the market. It ends up going against you and doesn't recover. Okay, let me see if I have a losing trade I can bring up about that and kind of touch on that. Let me see. Where's one of my losers? No. Bourbon, what was that? That was a short string. Let me have a vertical loser. Do I have a vertical loser? I don't get those often. I don't actually have any vertical losers. That's funny. That's good to know. I don't have any vertical losers. Wow. Let me check over here. Is this one a loser? That was a butterfly. That was... There we go. Okay, so I do have one. And this pop was 65.75. So I had put on a bear call spread on SPX, right? When the market was crazy at all-time highs back then. I put a bear call spread on the SPX. I bet against the trend because we were at all-time highs. And I had a 65-75%. Those are great probabilities. That's like my perfect setup. 65-75, I'll take that trade like that. I lost max loss on that trade. It just happens. Sometimes the market keeps going. News comes out and it doesn't recover. Unfortunately, it happens, but if you keep doing it, your probabilities will pay off. You know, that's what I'm getting at. With as amount as the losers that I have had, I'm sitting at a 75% win rate right now. So you just got to stick to the probabilities, follow them, maybe create a plan. I think I'm going to do this into the new year as well. Instead of, you know, right now my plan is max loss or 50% on a $5 wide vertical spread. Because I'm going in knowing what I'm about to lose, I'm okay with it. I'm going to probably change it up a little bit and do like 1.5 or 2 times the credit received to lower my losses a little bit. But the problem with that is sometimes, a lot of the times, it goes back and recovers. So you just kind of take the losers as they happen every now and then. All right. I had a high probability one, even better than the 65-75, and I lost. So you just got to... Most of the time, probabilities work in your effect, right? A lot of times when they don't, it's when you have news, you know. You had a 75% chance on Roku, and then Disney Plus comes out, right? And Roku tanks because of streaming. I don't know, I'm just saying that. That's a binary event. You really didn't know that was going to happen. You may have knew Disney was coming out, but you didn't know Roku would react that way. Same thing with Netflix. Good probabilities, but a news event, a tweet, something comes out and it blows your probability out a week later. It happens. Ben, when a trade moves against you, at what point will you exit the trade? I just touched on that. If it is a defined risk vertical spread, I go in knowing I'm going to take most likely max loss because it's hard to roll, hard to do anything. The only way to really roll a vertical spread is when it's kind of out of the money, but at the money. But even then, that's 100% profit if you hold on for 2 more weeks, right? So it's such a hard decision to make on stopping out. But I'm going to re-review my log and go over that. And like I just touched, I may take 1.5 to 2 times the credit received and call that my stop. And if I still like the trade, I'll re-enter and reposition. Okay. Sharon, will you do your SPX trades in this room? I will, Sharon. I'll most likely post them in both rooms. Robert, tied together chart text and spreads. For the most part, right? 90% probability, and then I look at the chart, confirm my direction. I'm not going to go bullish on something if it's been trending down. Now, if it's trending down, consolidating at lows, I might consider a bounce play, and I'll go even lower out of the money and take it back up, think it's going to come off its lows if the probabilities are really good. But I rarely do that. Let's see what Facebook's doing. Are we positive? I am. I may get out of this trade. Okay, let's see. What's a good theta decay to look for? I don't really look for theta decay like a number. I don't really look for a number, right? I don't care too much about it. A theta decay number. because you already know you're going to get that theta decay as the day goes on. As the day goes on, the days go by, the weeks go by, theta goes on. So I'm not like 65, 85. Oh, it's only 20. I don't do it that way. You already know you're going to have theta working in your favor. Nicole, it will be posted in, hold on a second. I'll show you where it's at. Under RB Elite, there is a section here. It's not under RB Elite anymore. It's actually, so you go to Raging Bull and then you just find mine right here. And you click on mine and the lesson will be here. Okay. But usually give about 24 hours after the lessons so that, because we got to we got to save them, change them, thread them, get them all put back on. All right, let's see. More questions. Wow, I am so far in chat. Sorry, guys, I'm still catching up. Thank you for answering that. Sorry, what do you mean about 1/3 the width? Paul, so 1/3 the width of the strike. If you look in here, this is a $5 wide strike, 31.70s, 31.65. So you take $5, you times it by 0.33, and 1/3 the width is $1.65. Okay, so like 1/3 the width of $1 is 33 cents pretty much. So then you just kind of go up from there, right? 33, 66, 99, $1.24, and then $1.65 or something like that. Okay, so that's what I mean by about 1/3, 1/4 of the width of the strike. Joseph, I know this element, but what is the 30 delta you're talking about? Joseph, so over here, I have delta on, and the delta is the rate of the change of that contract in regards to a dollar move on the underlying. So a 30 delta, I'll put it up here on my options chain. And this just means, right, that this 31.70 strike, it pretty much only has a 34% chance that it's going to be in the money, right? So I go to a 30 delta. This gives me 70%, or in this case, this would be right around 66% chance of being out of the money, okay? So that's why I look for a 30 delta. If you don't have Elite, do you still get the James Morris videos? Sharon, that's a good question. You should have it because it looks like Raging Bull. If you, I don't know that question, to be honest. I want to say yes. Randall, Ulta, $1.16 for me. Not only for but I'll be in this room, so you'll get me live a lot. Okay, thanks for the link. You're welcome. James, do you know if your alerts here will show up in RBE? Yeah, Ben, I will be posting them there as well. From my understanding, they will go there in RB Elite. Okay, out of Facebook. Got 6. Good job, Susan. I'm probably going to get out of it too and just cut it off. I'm getting hammered by theta. It is way higher than where I bought it, and I am 1% up. Thank you. 1/3 the width, the premium you want to collect. Exactly, Paul. You want to collect 1/3 the width of the strikes. So when you sell something, you want to get 1/3. Ulta here doesn't have that because it's not a good trade. But you want to try, right? I mean, and everyone's got their thing. Some people might like to collect $1 and go a lot further, but I like to get 1/3 the width starting off. Okay, this is a little low, but it's above the quarter. So, you know, you just got to try to get 1/3 the width. James, can you show an example of 1.5 to 2 times the loss? Okay, so it just depends, right? 1 time this, so say we got in at $1.50, right? That's what we got. The stop loss at 1 times the credit received would be what, $3? So just shy of max loss. So probably not going to go out 2 times because, but I'll probably go out at least 1 time. So if I got $1.50 for the trade, If it starts trading at $3, I would look to get out of the trade. Okay. Monica, good question. I believe he will be in here. We're still just getting it sorted out. Thanks, Nate. Let's see. Facebook calls. Good job, Kevin. How are we looking on Facebook? It's up 1%. I click on this, I can get to this room. Yeah, Jojo, this is the main room. Jojo, your profits. Yep. So then, Matt, on this example, right? Max gain, the most I can ever make if I put this trade on is $1.50, and that would be if it expired, worthless, come expiration. So I would want to hold it only until it was trading at 75 cents, and then I would buy it back for a debit, and then I keep the difference. Oh, Facebook is shooting. There we go. I think I might take Facebook off. Is it really in the close? No. Okay. 2 seconds. Really quick. I'm going to pause this. Uh-oh. I think I may have messed up the whole lesson now. Okay. I'm going to get out of Facebook while it's moving. I don't care that it's not quite 10%. I just want to get out. So I'm going to sit on the ask, see if I get filled while it's rolling up here. Okay. Which will be just over 6% if we get it. All right. So I think my recording is still going. Been on for a while. We got any more questions here? So when you say 30 delta, yep, Joseph. There we go. Out. I'm out of Facebook, guys, at small account. Out. Facebook calls at 252 plus 6%. So, okay. All right. Facebook may keep running here, guys, but I didn't want to wait anymore. Joseph, so yeah, when that area is showing a 30 delta, this is a bad example on Facebook, under delta, okay, 30s, right over here. In this case, it's negative on the put side, and it's positive on the call side, but that 30 delta is 30 delta, okay. Robert, sorry if you've answered this. Yeah, Robert, every person who has any service, regular, not elite, will have access to the regular RB room, which is the room I am currently in right now. If you have elite, you get the other room and this room, okay? But if you don't have elite, this is the room you get. All right. Okay, so that's it, guys. I'm gonna go and stop the recording. We've been kind of going on for a while. I will get this lesson uploaded and posted by tonight, and then that'll be it. Okay.